Walmart's stock is moving fast. And if you've been watching the tape closely, you already know this isn't just a routine post-earnings reaction. The volatility isn't random. The volume isn't casual. Something deliberate is happening under the surface, and almost nobody is breaking down the real signal behind it. Because when a company the size of Walmart Inc. starts accelerating in this kind of environment, it's rarely about a single earnings report. It's about positioning. Let's start with what most headlines are saying. Strong quarterly revenue. Solid U.S. comparable sales. E-commerce still growing at an impressive clip. Higher income shoppers continuing to shift their spending patterns. On paper, that sounds like a stable, defensive retail story. Predictable, boring, safe. But the stock didn't move like something boring. The move was sharp, volume expanded, options activity picked up, analysts quickly adjusted tone. And that's where things start getting interesting. Because if this were simply about good earnings, the reaction would have been straightforward. Modest upside, a steady grind, maybe a consolidation. Instead, we're seeing urgency. And urgency in a defensive giant like Walmart tells you something very specific about what larger players might be thinking. Here's the first layer that most coverage is missing. Walmart is not just a retailer anymore. It has quietly become a real-time barometer of American consumer stress, not optimism, stress. Over the past few years, Walmart has steadily increased its penetration among higher-income households. That shift matters. Historically, Walmart dominated value-conscious consumers. But when six-figure earners start shopping more aggressively at discount chains, it signals behavioral adjustment, not necessarily economic collapse, but recalibration. Consumers are trading down. And when consumers trade down while aggregate spending remains stable, companies like Walmart don't just survive, they capture share. Now look at the timing of this stock movement. We're entering a period where interest rate expectations remain fluid, credit card delinquencies are creeping higher, and housing affordability is still under pressure. Meanwhile, discretionary spending data shows select categories slowing while essentials remain resilient. Walmart thrives in that transition zone. The market understands this. But here's what's more nuanced. The move in Walmart stock suggests institutions may be rotating capital quietly, not because they're euphoric, but because they're preparing. Preparing for what? Possibly for a slower consumer in the back half of the year. Possibly for margin compression across mid-tier retailers. Possibly for volatility in growth names that benefited from speculative enthusiasm. When uncertainty increases, portfolio managers start asking one key question: where can I hide without leaving the market? And Walmart becomes one of those answers. But that's only part of the story. The second layer, and this is where the angle becomes more interesting, is structural transformation. Walmart's digital infrastructure has evolved far beyond curbside pickup headlines. Its logistics network now rivals, and in some regions competes aggressively with, Amazon.com Inc. in last-mile fulfillment density. Its marketplace model has expanded third-party sellers. Advertising revenue through Walmart Connect has grown meaningfully. Data monetization is no longer theoretical. That changes valuation psychology. If investors begin treating Walmart as a hybrid between a defensive retailer and a scaled logistics data platform, the multiple discussion shifts. It's no longer just price to earnings versus traditional brick-and-mortar peers. It becomes a blended narrative, part staple, part tech infrastructure, part digital ad platform. And blended narratives tend to move faster than pure defensive ones. There's also something subtle happening beneath the surface of earnings commentary. Inventory discipline. For years, retailers struggled with excess inventory cycles, over-ordering, markdown pressure, margin volatility. Walmart's recent operational cadence suggests a tighter rein on supply chain analytics. When a company of that scale improves forecasting precision even slightly, the impact on margins compounds dramatically. Margins are leverage, and leverage is what institutions chase. Now let's talk about psychology, because this is where many viewers miss the real game. When mega-cap tech stocks surge, retail investors feel momentum. When speculative sectors rally, they feel opportunity. But when Walmart trends, professionals feel caution. It's almost counterintuitive. A rising Walmart stock can reflect strength, but it can also reflect a defensive tilt inside portfolios. Capital doesn't move into giants like Walmart aggressively unless there's a reason to anchor risk. And anchoring risk doesn't happen when markets feel euphoric. So the speed of this move forces a deeper question. Is this a celebration of growth, or is this a hedge disguised as optimism? Because the difference matters. If this is growth-driven enthusiasm, we'd expect broader retail names to surge in tandem. If it's defensive positioning, we'd expect select consumer staples and discount chains to outperform more volatile peers. Look at relative strength charts over the next few weeks. That's where confirmation will emerge. Another overlooked dimension is buybacks and capital allocation. Walmart's balance sheet remains strong. When companies generate consistent free cash flow during uncertain macro conditions, they gain flexibility. That flexibility can manifest through repurchases, strategic investments, or infrastructure expansion, all of which support share price stability. Stability is attractive in a market that has grown addicted to extremes. There's also a demographic element. As inflation lingers unevenly across categories, groceries versus discretionary electronics, for example, consumers shift basket composition. Walmart's dominance in grocery provides recurring foot traffic. Recurring foot traffic creates cross-selling opportunity. Cross-selling opportunity enhances data capture. Data capture strengthens advertising revenue. That flywheel isn't flashy, but it's powerful. And markets reward flywheels. Now consider AI integration, not as a buzzword, but as an operational layer. Predictive inventory systems, dynamic pricing optimization, supply chain routing, targeted advertising algorithms. Efficiency at Walmart's scale doesn't just shave costs, it magnifies earnings stability. Stability commands premium treatment during volatility. So when you see Walmart stock moving fast, the instinct might be to assume it's a simple reaction to quarterly numbers, but the more sophisticated interpretation is that this is macro positioning intersecting with structural evolution. It's capital anticipating transition. The real question isn't whether Walmart had a good quarter. The real question is, what kind of environment encourages investors to accelerate into a $100+ billion revenue retailer at this speed? Because markets don't move billions of dollars without motive. And if you decode the motive correctly, you're not just reacting to Walmart's move, you're understanding what the broader market might be preparing for next. If Chapter 1 was about understanding the surface move, this is where we step deeper. Because when a stock like Walmart Inc. accelerates, the real story often isn't inside the earnings report. It's inside the asset allocation models quietly adjusting across Wall Street. Let's zoom out. Markets move in cycles of aggression and preservation. In aggressive phases, capital chases growth, innovation, speculative upside. In preservation phases, capital seeks durability, companies that can generate consistent cash flow regardless of economic turbulence. What's unusual right now is that we're seeing elements of both. Technology remains strong. AI names are still commanding attention. But at the same time, defensive giants are attracting serious flows. That dual behavior suggests uncertainty beneath the optimism, and that's where Walmart's move becomes more strategic than sensational. Institutional investors don't look at Walmart and see a retailer. They see cash flow stability, pricing power in essentials, logistics infrastructure that would cost tens of billions to replicate, and a consumer footprint that touches nearly every income bracket in America. That footprint is leverage. During economic expansion, Walmart captures volume. During economic compression, Walmart captures trade-down behavior. In both scenarios, revenue resiliency improves. Few companies have that dual elasticity. Now consider something subtle but critical. Pricing behavior. When inflation moderates unevenly, meaning some categories cool while others remain sticky, retailers face a complex balancing act. Raise prices too aggressively and you lose volume. Cut too aggressively and you compress margins. Walmart's scale gives it negotiation power with suppliers that smaller competitors simply don't possess. That means when cost pressures fluctuate, Walmart can absorb or offset them more effectively. Over time, that creates relative margin advantage. Relative advantage compounds. This is especially important if the broader retail landscape begins to show cracks. Mid-tier discretionary chains are more exposed to credit tightening. Specialty retailers often lack Walmart's grocery traffic engine. E-commerce-only operators face logistics cost pressure without physical store density to offset fulfillment expenses. In contrast, Walmart operates a blended model. Physical stores act as micro-fulfillment centers. Digital orders enhance basket size. Advertising monetizes traffic. Data refines targeting. That ecosystem doesn't rely on one revenue stream. It reinforces itself, and markets reward ecosystems more than single-channel businesses. Now, let's address something that many analysts hint at, but rarely articulate clearly: valuation perception. Historically, Walmart traded as a defensive staple: steady growth, moderate multiple, reliable dividend. But if investors begin treating Walmart as part infrastructure, part retail, part digital ad platform, the acceptable valuation range expands. That re-rating process doesn't happen loudly. It happens gradually through analyst commentary shifts and institutional modeling updates. And those shifts often begin with increased buying pressure before headlines fully catch up. There's also the psychological layer of concentration risk. Over the past several years, a handful of mega-cap technology stocks dominated portfolio returns. When leadership becomes concentrated, risk managers begin asking uncomfortable questions. What happens if sentiment rotates? What if regulatory or macro shifts disrupt momentum? Diversification doesn't mean abandoning growth. It means balancing exposure. Walmart fits that balancing act perfectly. It's large enough to matter, stable enough to defend, modern enough to justify. That combination makes it a natural rotational candidate when uncertainty creeps in. But here's the part that might matter most. If capital is flowing into Walmart not because of explosive growth expectations, but because of macro hedging behavior, that implies investors see potential turbulence ahead. Not necessarily a crash, not necessarily recession, but friction. Friction in credit markets, friction in discretionary spending, friction in earnings momentum across higher beta sectors. Walmart becomes a buffer against that friction, and buffers become valuable when volatility expectations rise. There's another signal embedded here: consumer data visibility. Walmart sees spending patterns in real time across grocery, apparel, household goods, electronics, seasonal categories, and more. That internal data stream offers insights into behavioral shifts before official macro reports reflect them. Large investors understand this. When Walmart commentary hints at shifts in basket composition or value-seeking behavior, sophisticated capital listens closely. Because if Walmart sees early signs of consumer caution, that data can inform broader portfolio strategy. In that sense, owning Walmart isn't just owning a retailer, it's owning exposure to one of the most granular consumer data engines in the country. Now layer in capital allocation discipline. When a company generates consistent operating cash flow and maintains manageable debt levels, it has flexibility during market stress. It can invest while others retrench. It can maintain pricing strategy without panic discounting. It can pursue acquisitions opportunistically. Flexibility becomes power in unstable cycles, and markets price power. Let's revisit the speed of this stock movement. Speed matters. Gradual appreciation reflects organic growth expectations. Accelerated movement often reflects repositioning. Repositioning implies urgency. Urgency implies anticipation. The real tension here is this: is Walmart's momentum a reflection of strength or a reflection of preparation for weakness elsewhere? Because if the latter proves true, then Walmart's chart isn't just about retail performance. It's about capital bracing itself. That's the angle most surface-level coverage avoids. They'll talk about comparable sales percentages and e-commerce growth rates. They'll highlight executive commentary and analyst upgrades. But the deeper layer is capital psychology. When investors move aggressively into stability, they're rarely doing it randomly. They're adjusting for something. So as you watch this move unfold, don't just ask whether Walmart's quarter was strong. Ask what kind of market environment makes defensive infrastructure look increasingly attractive. Ask why institutional flows would accelerate into a company that thrives when consumers trade down. Ask what that implies about expectations for credit, inflation persistence, and discretionary resilience. Because sometimes the stock that looks the safest on the surface is quietly signaling that the market sees something coming. And if you interpret that signal correctly, you're not just analyzing Walmart, you're reading the market's mood before it fully reveals itself.